Every year, millions of hard-working professionals watch their wealth slowly leak out of their personal economies through a series of invisible financial drains. They pay interest on car loans, finance their business operations through commercial lenders, and watch their savings lose purchasing power in traditional bank accounts. Most people believe this is simply the unavoidable cost of participating in modern society, a necessary tax on survival. But there is a quiet class of wealth builders who operate under an entirely different set of rules. They do not pay interest to commercial banks. Instead, they have built their own private financial ecosystems, where every dollar spent is simultaneously borrowed, compounded, and recaptured. This is not a complex corporate shell game or an offshore tax haven. It is a highly engineered system known as the private family bank. To understand how this system operates, we must contrast two different financial paths. Let us look at Julian and Marcus. Both are highly successful professionals, each earning an annual income of $300,000. Julian is a senior project manager at a major engineering firm. He follows all the traditional financial advice. He maximizes his contributions to his 401k, maintains a clean credit score, and keeps $50,000 of liquid cash in a savings account at a national bank. When Julian needs to buy a $50,000 commercial vehicle for his consulting work, he goes to the bank. He secures a 5-year loan at an interest rate of 8%. Every month, Julian dutifully sends his principal and interest payments to the commercial lender. His money leaves his pocket, enters the bank, and is gone forever. Now let us look at Marcus. Marcus runs a consulting firm and earns the exact same $300,000 as Julian. However, Marcus understands the concept of opportunity cost. He knows that once a dollar is spent, it stops earning for him. It loses its ability to compound forever. Instead of placing his liquid cash into a commercial bank account, Marcus directs his savings into a custom-engineered contract. When Marcus needs to buy the exact same $50,000 vehicle, he does not apply for a traditional auto loan. He does not liquidate his investments. Instead, Marcus contacts his private family bank. He requests a policy loan of $50,000. The funds are wired to his account within 48 hours. He buys the vehicle cash and begins paying himself back with interest. At first glance, this might look like a simple accounting trick. After all, Marcus is still paying interest, and he still had to fund the system. But when you look at the underlying mathematics, the differences are staggering. While Julian is paying 8% interest to a multi-billion-dollar bank, Marcus is paying interest back to a system that he completely owns. More importantly, the $50,000 that Marcus borrowed never actually left his compounding engine. His entire capital base continued to grow at an uninterrupted compound rate, even while he was driving the vehicle. To understand how this is mathematically possible, we must dissect the inner workings of the modern banking system and the specialized contract that makes the private family bank a reality. The foundation of Marcus's strategy lies in replicating the exact business model of commercial banks. When you deposit $1,000 into a local bank branch, that money does not sit in a vault waiting for you. Under the laws of fractional reserve banking, the bank is only required to keep a small percentage of your deposit on hand, often as low as 10%. The remaining $900 is immediately loaned out to other customers in the form of mortgages, auto loans, and credit cards. The bank pays you a fraction of a percent on your savings deposit, but charges those borrowers 5, 8, or 15% on their loans. The bank captures the massive spread between what they pay you and what they charge others. This is called the net interest margin. It is the oldest and most lucrative wealth-building mechanism in human history. Marcus realized that instead of being the depositor who funds the bank's wealth, he could become both the depositor and the lender. To do this, he utilized a highly specialized financial tool, a dividend-paying whole life insurance policy issued by a mutually owned insurance company. This is a critical distinction. A stock insurance company is owned by external shareholders, meaning their primary goal is to maximize profit for Wall Street. A mutual insurance company, however, is owned entirely by its policyholders. When you own a policy with a mutual company, you are a part owner of the corporation. You are legally entitled to share in the company's profits in the form of annual dividends. This is not the standard whole life insurance policy that is aggressively pushed by traditional retail insurance agents. Standard whole life policies are structured to maximize the commission of the agent. They put almost all of your early premium payments toward the death benefit and corporate fees, resulting in zero cash value for the first several years. Marcus's policy is custom designed using specific financial riders. It redirects up to 80% of his premium into what is called paid-up additions. This structural shift minimizes the agent's commission and maximizes the immediate cash value. This means that from year one, Marcus has access to a highly liquid pool of capital that grows tax-free. The tax advantages of this structure are protected by the federal government under Section 7702 of the Internal Revenue Code. This section defines how life insurance contracts are taxed. Under these rules, the cash value within the policy grows completely tax-deferred. Furthermore, when Marcus takes a loan against his policy, the loan proceeds are not considered income. This means he can access his cash tax-free at any time, for any reason, without the age restrictions or penalty fees associated with traditional retirement accounts like a 401k or an individual retirement account. But the true mathematical engine of the private family bank is a concept known as non-direct recognition. When Julian withdraws $50,000 from his traditional savings account to buy a car, his account balance drops to zero. He stops earning interest on that money. When Marcus takes a policy loan of $50,000, the insurance company does not actually touch his cash value. His $50,000 remains inside the policy, completely intact. The insurance company is actually lending Marcus their own corporate money, using his cash value as collateral. Because Marcus's $50,000 never left his policy, it continues to earn dividends and compound interest as if he had never borrowed a single penny. His money is working in two places at the exact same time. Let us look at the long-term math of this transaction. Julian pays his 8% interest to the commercial bank and watches his net worth stagnate while his asset depreciates. At the end of 5 years, Julian's auto loan is fully paid off. His vehicle is now worth only $25,000, and the interest he paid to the commercial bank is gone from his personal economy forever. His savings account sits at $50,000, earning a meager 1%, which inflation and taxes entirely wiped out. Now let us examine Marcus's asset sheet over those exact same 5 years. Marcus also paid off his vehicle. He structured his repayments to match the commercial market rate of 8%, sending those payments directly back to his insurance policy to clear the outstanding loan. But because of the non-direct recognition feature, his $50,000 of cash value never stopped compounding. Throughout that entire 5-year period, his $50,000 was earning a guaranteed interest rate of 4%, plus a dividend of 2%, yielding a total return of 6%. This compounding was calculated on the full $50,000, not on the declining balance of the loan. By the end of year 5, Marcus's cash value has grown to more than $66,000, and his loan is completely paid off. He now owns the $25,000 vehicle, and he has $66,000 of liquid cash sitting in his policy. Julian has a depreciated vehicle and his original $50,000 in a low-yield account. The structural difference between these two systems is over $16,000 on a single transaction. To understand why this happens, we must study the math of compound interest versus the math of amortized loans. When you take a loan from a commercial bank, the interest is amortized. This means you pay a massive amount of interest in the early years of the loan and very little principal. The bank fronts its profit. When you compound your money inside a private family bank, the growth curve is exponential. It starts slow, but gains massive momentum over time. When Marcus borrows against his policy, he is exploiting this mathematical asymmetry. He is borrowing at a simple interest rate, while his collateral is compounding at a compound interest rate. Even if the loan interest rate is exactly equal to the policy growth rate, Marcus still wins because of the way the math is structured. Let us look at a larger scale scenario to see how this system scales. Marcus decides to expand his consulting business. He needs to purchase $100,000 of computer hardware and office equipment. Julian, facing the same expansion need, goes to a leasing company, which charges 10% interest over 3 years, making Julian pay $3,200 a month. At the end of 3 years, Julian has paid over $15,000 in interest, and he does not own the equipment. Marcus, on the other hand, makes an annual premium payment of $40,000 into his policy. He has done this for 5 years, meaning his total cash value is over $200,000. Marcus takes a tax-free policy loan of $100,000 at a 5% interest rate. He purchases the equipment cash. He then drafts a promissory note between his operating business and his private family bank. His business agrees to pay the private family bank $3,200 a month, the exact same amount Julian is paying to the leasing company. This is the core of debt recycling. The business gets a tax deduction for the interest paid on the equipment loan, and those interest payments are going directly back into Marcus's private family bank. The interest is recaptured, instead of being lost to an outside lender. By doing this, Marcus has successfully integrated his business cash flow with his personal wealth-building engine. He has turned a business expense into a personal compounding asset, while Julian's business cash flow is permanently leaving his ecosystem to enrich a third-party leasing company. Marcus's business cash flow is staying inside his family's balance sheet. This concept is known as the velocity of money. It is the rate at which money flows through your personal economy. The average person has a low velocity of money. They earn $1, they pay taxes, they deposit it in a commercial bank, and then they spend it. The money only does one job before it is gone. Marcus has designed a high-velocity system. His dollar earns an income. It is deposited into his policy. It compounds tax-free. It is borrowed to fund a business expense. The business pays it back with interest, and the compounding never stops. One single paper dollar is doing 4 or 5 jobs simultaneously. This is how the wealthy build generational assets. They do not search for high-risk investments to make up for lost capital. They simply stop the wealth leaks in their everyday lives. But to execute this strategy successfully, one must understand the difference between direct recognition and non-direct recognition mutual insurance companies. Many national insurance providers utilize direct recognition. This means that when you take a loan against your policy, the company lowers the dividend rate on the cash value that is being used as collateral. For example, if the normal dividend rate is 6%, they might lower it to 3% on the portion of your cash value you have borrowed. This drastically reduces the compounding effect and ruins the private banking mathematics. Non-direct recognition companies do not change the dividend rate. Whether you have $0 borrowed or 100% of your cash value borrowed, they pay you the exact same dividend on your entire cash value. This is the secret mechanism that allows Marcus to achieve positive arbitrage. Furthermore, the design of the policy itself requires meticulous engineering. Traditional whole life insurance policies are heavily front-loaded with commissions for the selling agent. Often, 100% of your first-year premium goes directly to the agent's pocket. This is why whole life insurance has a poor reputation among mainstream financial commentators. They are looking at poorly designed retail products. To make a private family bank work, the policy must be structured as a high cash value vehicle. This is done by blending a small base whole life policy with a large term insurance rider and a paid-up additions rider. This blend lowers commissions by 90%, redirecting those funds into cash value from day one, creating a highly liquid system where you borrow and recycle debt immediately, without having to wait for bank approvals or jump through regulatory hoops. This immediate liquidity allows Marcus to capitalize on distressed assets and time-sensitive investment opportunities before traditional buyers can even schedule an appointment with a loan officer. For instance, Marcus identifies a cash-flowing duplex priced at $200,000. Instead of applying for a conventional mortgage which would require a 20% down payment and weeks of underwriting, Marcus simply requests a policy loan of $40,000 from his custom whole life contract to cover the down payment. He secures a private money loan for the remaining balance. Within days, the deal is closed, and the duplex begins generating rental income. The duplex generates $1,500 a month in positive net cash flow after expenses. Marcus directs this monthly rental income straight back to his insurance policy to repay the outstanding $40,000 policy loan. Since his $40,000 of collateral remained inside his policy earning an uninterrupted 6% dividend, Marcus is experiencing a phenomenon known as positive arbitrage. He is paying a lower simple interest rate on his loan than the compound interest rate his collateral is earning. Once the rental cash flow completely pays off the policy loan, Marcus is left with a fully paid down real estate asset, and his original $40,000 is back in his liquid policy cash value, ready to be deployed into the next investment. He has successfully manufactured wealth out of thin air by using the exact same dollar twice. Now, contrast this with Julian. Julian wants to buy the exact same duplex. But because Julian keeps his $50,000 of liquid cash in a traditional bank savings account, he has to withdraw his own $40,000 directly to make the down payment. This withdrawal drops his savings account balance to $10,000, and he instantly stops earning even the minor 1% interest on that $40,000. To rebuild his savings, Julian must save money from his consulting and engineering salary, which is taxed at the highest federal and state tax brackets. For every dollar Julian earns, nearly 40% is taken by the government before it ever reaches his savings account. This massive tax drag makes rebuilding his liquid capital an incredibly slow and painful process. This brings us to the core issue of the traditional financial system, the tax trap of tax-deferred retirement accounts. Julian has been taught that maximizing his contribution to a 401k is the ultimate way to build wealth and save on taxes. Every year, Julian contributes $23,000 to his company's 401k plan. This lowers his current taxable income, but it creates a massive, ticking tax liability for his future self. Because a 401k is tax-deferred, Julian is not actually avoiding taxes. He is simply postponing them to a later date, when tax rates might be significantly higher. More importantly, he has given up control of his money. If Julian needs to access those funds before age 59 and a half, he faces a 10% penalty from the Internal Revenue Service, plus ordinary income taxes on the entire withdrawal. Furthermore, when Julian eventually retires and begins withdrawing from his 401k, every single dollar he takes out will be taxed as ordinary income, not at the lower capital gains rate. This is a crucial distinction. If Julian's retirement account grew to $1 million, and he withdraws $50,000 a year, he will pay regular federal and state income taxes on that $50,000. If tax rates have risen to 40% by that time, Julian will watch his hard-earned wealth dissolve into the hands of the government. Marcus's private family bank operates on an entirely different legal architecture. Under Section 7702 of the tax code, Marcus can access his cash value through tax-free policy loans, because a loan is not legally classified as taxable income. This brings us to the ultimate step in the systemic process, the concept of transfer and recapture upon death. In the buy, borrow, and die strategy, the death phase is not a tragedy. It is the final mathematical calculation that cleans the balance sheet completely tax-free. Let us look at what happens when Marcus passes away at age 85. Over his lifetime, Marcus has built his custom policy to have a death benefit of $3 million. At the time of his passing, Marcus has an outstanding policy loan of $500,000, which he used over the years to buy real estate, fund business expansions, and live a comfortable retirement. This $500,000 loan was never paid back during his lifetime, and it was compounding at a simple interest rate of 5%. Under normal tax laws, if you pass away with outstanding debt, your estate must liquidate its assets to pay off those creditors. This often triggers massive capital gains taxes and leaves your heirs with a fraction of your wealth. But the private family bank operates under unique statutory protections. When Marcus dies, the insurance company does not send a bill to his estate. They simply take the outstanding loan balance of $500,000 plus the accrued interest and subtract it directly from the $3 million death benefit. The remaining $2,500,000 is paid out to Marcus's heirs, completely income tax-free. The debt was completely wiped out by the death benefit, and the heirs receive their inheritance within weeks, without paying a single dollar in taxes. Now, let us examine what happens to Julian's heirs. When Julian passes away at age 85, his estate is highly vulnerable. His $1 million 401k has been subjected to mandatory distributions over the years, which forced him to withdraw capital and pay taxes during his retirement. The remaining balance of his 401k is passed to his children. But under the Secure Act, non-spouse beneficiaries are contractually required to fully distribute and pay taxes on an inherited 401k within 10 years. This means Julian's children, who are in their peak earning years, will be forced to withdraw $100,000 a year, adding massive tax liabilities. Furthermore, Julian's real estate investments are tied up in probate court, meaning his heirs cannot touch or sell the properties for months while lawyers and courts dissect his estate. To make matters worse, the real estate may trigger capital gains taxes if the heirs are forced to sell them quickly to pay off Julian's remaining medical debts or credit card balances. The systemic decay of Julian's wealth upon death is the final proof that traditional financial systems are designed to harvest assets, not protect them. Marcus, by contrast, has built a seamless conveyor belt of wealth. His assets pass to his heirs outside of probate, completely tax-free, and his private family bank remained fully funded and operational, ready for his children to repeat the exact same system. But building this system requires navigating a minefield of federal tax regulations. If you construct the policy incorrectly, the Internal Revenue Service will strip away all of its tax advantages, reclassifying your asset as a highly taxed vehicle. To understand how to build a private family bank from scratch, we must look at the mechanical architecture of the contract. In 1988, the federal government noticed that wealthy individuals were dumping cash into single premium life insurance policies, using them as tax-free shelters. In response, Congress passed the Technical and Miscellaneous Revenue Act, which created a new tax classification known as a modified endowment contract. If a policy is classified as a modified endowment contract, it loses its tax-free status on loans and withdrawals. Any money Marcus borrows from a modified endowment contract is taxed on a last and first-out basis, meaning the growth is taxed first and is subject to a 10% penalty before age 59 and a half. To avoid this penalty, the policy must pass the 7-pay test. The 7-pay test is a mathematical limitation codified under Section 7702 of the Internal Revenue Code. It calculates the maximum amount of cash you can deposit into a life insurance contract over a 7-year period relative to the size of the death benefit. To make sure his policy passes the 7-pay test and remains tax-exempt, Marcus must balance two competing forces. He wants to deposit as much cash as possible into the policy, while maintaining the smallest possible death benefit. He wants a small death benefit because the cost of insurance is deducted from his cash value every month. A smaller death benefit means lower insurance costs, leaving more of his cash value to compound. But if Marcus deposits too much cash into a small death benefit policy, he violates the 7-pay limit, and the policy becomes a modified endowment contract. To solve this mathematical riddle, Marcus's custom policy uses a specific structural blend. He splits his $40,000 annual premium into two separate channels. The first channel is the base premium. This is the traditional whole life premium. It buys the core death benefit, but generates almost zero cash value in the early years because it is eaten up by commissions and administrative overhead. Marcus structures this base premium to be only 10% of his total contribution, or $4,000 a year. The second channel is the paid-up additions rider. This is the secret premium accelerator. The remaining 90% of Marcus's contribution, or $36,000 a year, is directed straight into the paid-up additions rider. This money bypasses the agent's commission and goes directly into his liquid cash value, where it begins compounding and earning dividends on day one. But this 10/90 split creates an immediate problem. A policy with a tiny $4,000 base premium does not have a large enough death benefit to support a $36,000 paid-up additions payment under the 7-pay test. The policy would immediately fail the test and become a modified endowment contract. To fix this structural defect, Marcus's designer adds a third component to the contract, a term insurance rider. This term rider acts as a temporary scaffold. It provides a massive amount of inexpensive death benefit, raising the policy's total death benefit. This artificial expansion of the death benefit creates enough legal room under the Internal Revenue Code to allow Marcus to deposit his full $40,000 premium without violating the 7-pay test. As the years pass, the cash value inside Marcus's policy grows larger and larger. Every dollar of paid-up additions he purchases buys a micro-slice of fully paid-up death benefit. This paid-up death benefit permanently replaces the cheap term insurance rider. Year by year, the term rider shrinks and dissolves, while the permanent, paid-up death benefit expands. Eventually, the temporary term scaffold is completely removed, leaving behind a massive, highly efficient, permanent cash compounding engine. But qualifying for this financial vehicle requires passing a process known as medical and financial underwriting. Life insurance companies do not simply allow anyone to dump millions of dollars into their corporate reserves. They must manage their risk. Underwriting analyzes Marcus's physical health and financial net worth. They review his medical history, require a physical exam, and analyze his blood. This determines his health rating, which dictates the actual cost of insurance. The healthier Marcus is, the lower his internal costs, leaving more of his money to compound inside his private bank. Next comes financial underwriting. This is where the insurance company calculates what is called human life value. This is a mathematical limit on the maximum death benefit Marcus can qualify for. The company will not allow Marcus to buy a $10 million policy if his income is $30,000, as this creates an adverse selection risk. They ensure policy size aligns with actual economic worth. Since Marcus earns $300,000, underwriters determine his human life value is 20 times his income, qualifying him for up to $6 million of death benefit. This massive underwriting limit gives Marcus more than enough room to construct his private family bank with maximum efficiency. Now let us look at how the actual dividend mechanics operate once the policy is funded. At the end of every fiscal year, the board of directors of the mutual insurance company meets. They analyze the company's financial performance over the past 12 months. They look at their total premium income, subtract their administrative expenses, and evaluate their investment yields. Because these mutual insurance companies invest their massive asset pools with extreme conservatism, typically in AAA-rated commercial mortgages, long-term corporate bonds, and government debt, they enjoy highly stable returns. When the mutual company generates a financial surplus, they are contractually obligated to return those profits to the owners, who are the policyholders. This return of profit is called a dividend. Although the federal government legally classifies these dividends as a return of overpaid premium, which is why they are completely tax-free, they function exactly like a compound interest yield. If Marcus's policy has a cash value of $200,000 and the mutual company declares a 6% dividend, Marcus's custom banking account receives $12,000. This $12,000 profit is immediately reinvested right back into the policy, purchasing more paid-up additions, which expands his capital base for the next year. Over the course of several decades, this continuous cycle of tax-free growth and reinvestment builds an unstoppable momentum, changing not just Marcus's personal life, but the entire financial destiny of his bloodline. To fully understand the long-term power of these two contrasting systems, we must fast-forward 50 years into the future, looking at the second and third generations of both families. Julian's family is experiencing what sociologists call wealth regression. When Julian passed away, his estate was subjected to a battery of taxes, probate expenses, and legal fees. His children, lacking any real financial education, relied entirely on high-fee institutional money managers to invest their diminished inheritance. They watched their funds slowly evaporate through market corrections, management fees, and ordinary income taxes on their mandatory distributions. Within 25 years of Julian's passing, his life's work was entirely depleted, leaving his grandchildren back at the exact same starting line, working for hourly wages and taking on heavy student loan debt to fund their educations. They are trapped in the exact same commercial debt cycle that Julian spent his life servicing. This is the hidden reality of the traditional financial system. It is designed to act as a temporary parking spot, allowing you to accumulate assets just long enough for the government and institutional lenders to harvest them. Now, look at the family legacy of Marcus. Marcus did not leave his heirs a standard lump sum inheritance. Instead, he left them a fully integrated, multi-generational corporate and legal architecture. Before his passing, Marcus established the Marcus Family Trust. This trust was named as the sole beneficiary of his custom whole life insurance contracts. When the $2,500,000 tax-free death benefit was paid out, it did not go to his children's personal bank accounts, where it could be spent, sued, or taxed. Instead, the capital flowed directly into the trust, which was contractually structured to operate as a permanent family bank. The trust immediately took those funds and purchased new, high cash value whole life insurance policies on the lives of Marcus's children and grandchildren. This created a continuous loop of compounding capital. When Marcus's granddaughter, Sarah, wants to attend a prestigious university, she does not apply for government student loans. Instead, she submits a business plan to the trust's board of trustees. The trust approves a policy loan from the family bank to cover her tuition. Sarah receives her education completely debt-free, and once she graduates and begins her career, she pays the loan back to the trust with 5% interest. By paying back the trust with interest, Sarah is actively compounding and increasing the wealth of her family's private bank, ensuring that there is even more capital available for the next generation. When her brother, David, wants to start a business, he follows the exact same process. He borrows $100,000 directly from the trust's massive cash value reserves, buys his commercial assets, and uses his business profits to recycle that debt back into the family ecosystem. No money ever leaves the protective boundary of the family circle. The spread that once enriched commercial bankers is now permanently captured by Marcus's descendants. This is the ultimate long-term systemic compounding effect. When David and Sarah eventually pass away, the death benefits from their policies are paid straight back into the trust, completely clearing any outstanding loans and injecting millions of dollars of fresh, tax-free capital into the system. Generation after generation, the wealth of the Marcus family bank compounds, becoming an unstoppable financial fortress. While Julian's family is forced to sell assets and take on debt to survive, Marcus's family is using their private bank to fund businesses, acquire real estate, and protect their legacy from taxes and economic crashes. They have built a system that is entirely immune to the parasitic leaks of the modern economy. To summarize the complete mathematical architecture of the private family bank, we must look at the 4 key pillars of the strategy. The first pillar is cash value engineering. By carefully structuring your policy with a premier mutual insurance company using a 90-10 premium blend, you maximize your immediate liquidity, completely bypassing high agent commissions and administrative corporate overhead. The second pillar is non-direct recognition loan mechanics. This ensures that when you take a policy loan against your cash value, the insurance company continues to pay you dividends on your entire collateral base, allowing your money to work and grow in 2 completely separate places at the exact same time. The third pillar is positive arbitrage. By borrowing money at a simple interest rate while your collateral compounds at a higher compound rate, you create a continuous spread in your favor, turning interest payments into a wealth-building asset. The fourth and final pillar is tax exemption under Section 7702. This statutory protection allows you to grow your wealth tax-free, borrow against it tax-free, and pass it to your heirs completely tax-free through the death benefit. Combined, these 4 pillars allow you to legally exit the commercial banking loop, recapturing the net interest margin for your own family. As you watch the stories of Julian and Marcus unfold, you must ask yourself a critical question. Where is the cash flow in your personal economy currently escaping to? Every single day, you are presented with a clear choice. Every single time you make an auto loan payment, every single time you pay high interest on business equipment, and every time you leave your savings in a traditional bank account, you are actively funding the wealth of someone else. You are playing the role of the depositor, allowing multi-billion-dollar commercial banks to leverage your hard-earned cash to fuel their own massive corporate profits. The system is engineered to encourage this, but as Marcus has clearly proven to us, you do not have to participate in this rigged game. You can choose to stop the constant cash leakage today. You can choose to reclaim the banking function in your life and build an engineered family safety net that grows, protects, and transfers your wealth completely tax-free. It requires a shift in perspective, a willingness to reject mainstream financial advice, and the unwavering discipline required to structure and fund a custom system. But the mathematical reality is undeniable. You can continue to be Julian, watching your assets slowly leak away through taxes, interest, and inflation, or you can choose to be Marcus, building an unstoppable, quiet fortune that compounds for generations, completely secure inside your very own private family bank.